Most people think economic problems start with central banks, inflation, or political decisions. But what if the real shift is happening somewhere most people never look? Because right now, while everyone is waiting for interest rate cuts in the United States and Canada, something deeper is changing underneath the system. And that shift begins in Japan. For decades, Japan has been one of the most important but least talked about players in global finance. Not because it dominates headlines, but because it quietly influenced how money moved across the world. To understand this, we have to go back to the early 1990s, when Japan's financial bubble collapsed. Real estate prices crashed. Stock markets fell sharply. And the economy entered a long period of stagnation. Growth slowed down, inflation disappeared, and wages barely moved for years. This period became known as the lost decades. In response, Japan's central bank started cutting interest rates aggressively. Over time, those rates were pushed close to zero. And when that still didn't fix the problem, they went even further, keeping long-term interest rates extremely low for an extended period. This created a unique situation where money in Japan became incredibly cheap. When money becomes extremely cheap in one part of the world, it doesn't stay there for long. Capital always looks for better returns, and that's exactly what happened in Japan. Investors, banks, and large institutions realized that keeping money inside the country wasn't giving them any meaningful return. So they started looking outside. They began investing heavily in places like the United States and Canada, where interest rates were higher and returns were more attractive. But this wasn't just simple investing. It became something much bigger. Investors started borrowing money in Japan at near zero interest rates and then converting that money into dollars. Once converted, they would invest it into assets that paid higher yields, like government bonds, corporate debt, or even stocks. At first, this might sound like a small strategy, but over time it scaled massively. Thousands of investors started doing the same thing, and eventually it turned into trillions of dollars moving across global markets. This flow of money helped push asset prices higher and kept borrowing costs lower in countries receiving that capital. Because when there is more demand for bonds, their yields tend to stay lower. And when yields are lower, borrowing becomes cheaper for governments, businesses, and consumers. That's one of the hidden reasons why mortgage rates in the United States and Canada were able to stay relatively low for such a long time. At the same time, this constant inflow of capital also supported stock markets. When money is cheap and easily available, investors are more willing to take risks. They invest in growth companies, real estate, and other assets that benefit from low interest rates. So over the years, this system quietly became a backbone of global liquidity. But here's the important part. This entire structure depended on one key assumption: that borrowing costs in Japan would remain extremely low and stable. As long as that condition held, the system worked smoothly. But if that ever changed, the entire dynamic would begin to shift. And recently, that shift has started to happen. Japan began adjusting its policies. Interest rates started to rise, even if only slightly. Controls that once kept long-term yields pinned down began to loosen. And while these changes may seem small on the surface, they have a much larger impact when trillions of dollars are involved. Because the moment borrowing in Japan becomes more expensive, the math behind these global strategies changes. What used to be an easy profit opportunity starts to shrink. The gap between borrowing costs and investment returns gets smaller. And suddenly, the trade doesn't look as attractive as it once did. When that happens, investors don't wait around. They start adjusting their positions. Some reduce their exposure to foreign assets. Others stop putting new money into these trades. And in many cases, capital starts flowing back toward Japan. This process is known as capital repatriation. It simply means money that once flowed out of a country begins to return home. Now imagine this happening not with a small amount of money, but with massive global capital that has been spread across different markets for decades. As that money starts to move back, demand for assets in other countries begins to weaken. And this is where the effects start to become visible. Because in places like the United States and Canada, governments rely on strong demand for their bonds. When demand is high, borrowing costs stay manageable. But if demand weakens, yields have to rise to attract new buyers. And when yields rise, it doesn't just stay limited to the bond market. It spreads across the entire financial system. One of the first places this shows up is in mortgage rates. Long-term government bond yields play a major role in determining mortgage rates. So even if central banks signal rate cuts, mortgage rates don't always fall the way people expect. If global demand for bonds is changing, those long-term rates can remain elevated. That's why many people feel confused. They hear about potential rate cuts, but borrowing costs for homes still feel high. The missing piece is that long-term rates are influenced by global capital flows, not just domestic policy decisions. And as those flows shift, the impact becomes harder to ignore. The stock market also reacts to this environment. When interest rates stay higher for longer, the value of future earnings changes. Investors use interest rates to determine how much future profits are worth today. If rates are higher, those future profits are discounted more heavily. This leads to lower valuations, even if companies continue to perform well. As a result, markets can become more volatile. Prices move more aggressively, and investor sentiment becomes more sensitive to changes in interest rates. And again, this connects back to the same underlying factor. The cost of money is changing. Beyond stocks and housing, the broader economy also feels the pressure. When borrowing costs remain elevated, businesses become more cautious. They delay expansion plans, reduce investments, and focus more on stability rather than growth. Consumers also feel the impact. Higher interest rates make loans more expensive, which affects spending decisions. Over time, this can slow down economic activity. And what makes this situation more complex is that it doesn't come from a single decision or event. It comes from a gradual shift in how global money moves. This is where a major misunderstanding often happens. Many people assume that if central banks cut rates, financial conditions will automatically ease. But that's not always the case. Central banks mainly control short-term interest rates. Long-term rates, which influence mortgages and many other financial decisions, are shaped by global supply and demand. So even if short-term rates come down, long-term rates can stay elevated if demand for bonds weakens. And that creates a situation where policy changes don't have the same impact people expect. What we are seeing now is not a sudden crisis, but a slow structural shift. For years, the global financial system benefited from a steady supply of cheap capital. That environment supported growth, boosted asset prices, and kept borrowing costs relatively low. Now, that environment is beginning to change. The transition may take time, but its effects are already starting to appear in different parts of the market. And because it's happening gradually, many people overlook it. What we are seeing now is not a sudden crisis, but a slow structural shift. For years, the global financial system benefited from a steady supply of cheap capital. That environment supported growth, boosted asset prices, and kept borrowing costs relatively low. Now, that environment is beginning to change. The transition may take time, but its effects are already starting to appear in different parts of the market. And because it's happening gradually, many people overlook it. The reality is that some of the most important changes in financial markets are not the ones that make headlines. They are the ones that happen quietly, in the background, shaping the foundation of how money flows through the system. And when that foundation starts to shift, everything built on top of it begins to feel different. Interest rates behave differently. Markets react differently. Economic conditions evolve in ways that are not always easy to predict. That's why understanding these underlying forces matters. Because the biggest risks are often not the loudest ones. They are the ones hiding in plain sight, slowly changing the system while most people are focused somewhere else.